Good afternoon, everybody, and welcome to our monthly tax investigations webinar. My name is Dave Jennings. I'm ex-HMRC, top 10 firms of accountants. I've 30 odd years experience of investigations disclosures on both sides of the revenue divide, both sides of the fence, gamekeeper turned poacher cliche, a published author and chartered tax advisor. And my colleague here, Dane Skiba, is joining us today. Dane's also ex-HMRC, big top 10 firms of accountants as well, and equally many years, decade or so of experience with investigations disclosures. So we both know the ins and outs of HMRC, and today we're going to talk about the ins and outs of property investigations and disclosures. You can type in the chat box questions, although we do seem to be having some IT issues with the questions. We may not be able to actually see them, but hopefully we can. So if you do have any questions today, please type them in. Obviously, if you're watching the recording of this, you won't be able to send questions live to us, but you can contact us if you have any queries or questions about property or any investigations or disclosures that you or your client may need to make. Without further ado, I will start the presentation. So our intro. So, we do provide full service to clients. A lot of our investigation work tends to be with other accountants, solicitors, IFAs, and we help them with their clients. So today we're going to cover what happens if income or gains from property specifically has not been declared. Should that be either a voluntary disclosure or by way of HMRC opening an investigation. We are also going to cover what expenses you can claim for property, and again that's relevant for either disclosures or inquiries or even completing tax returns each year. We're also going to then include issues about SDLT, which remains topical, and obviously now the SDLT changes this year have all gone. SDLT is back in the picture with paying those liabilities on new property exchanges. Dane's then also going to cover ATED, which is maybe something people aren't as familiar about, but we do know HMRC have started issuing letters and inquiries into ATED. So he will tell you all about that and what to watch out for. Finally, I'll wrap up with private residence relief. Similar to any sort of investigation or any income that's not been disclosed to HMRC, they can investigate property income, so rental income that's not been disclosed, or capital gains from selling properties that's not been disclosed, and they can even prosecute. So in the most serious cases, it can result in criminal prosecution if income gains have not been disclosed and HMRC are able to prove fraud. Failing to pay your taxes, declare your taxes, can be a criminal offence of tax evasion. So you may think property isn't that serious. Everybody does it. There are a million landlords in the UK. Surely it's just a civil matter. Well, it isn't just a civil matter. It obviously would depend on cases. I've and the team have helped landlords with large property portfolios that, for whatever reasons, have not been disclosed to HMRC in the past, and we've corrected that position going forward. Or they've faced investigations from HMRC, and we've handled their cases and investigations. It's surprising that these things do happen for all sorts of different reasons. People become accidental landlords through maybe divorce or separation, or friends moving from houses and then renting out. So that can happen too, and people forget to make those disclosures. Or they deliberately don't make those disclosures. Obviously that affects the penalties, the liabilities, the form of disclosure. HMRC have been issuing for the last 5-6 years at least, if not longer. I can't remember when the Let Property campaign first started. Probably should have looked that up before joining this webinar. But it's certainly been around for a long time, and they are still issuing nudge letters. What that means is HMRC has information that they believe the individual or the company or whoever is a landlord of property that's not been disclosed or gains that have not been declared. The revenue have information from land registry, from stamps documents, from gathering information from solicitors, estate agents, council tax, housing benefit. They have all sorts of information, and if they've not opened an inquiry, they give somebody the opportunity to make a disclosure. If you receive one of these letters, do not ignore it. If you ignore it, it's at your own peril. HMRC will eventually open an investigation if you don't respond. It will still be a prompted disclosure. It won't be a wholly voluntary disclosure. You received a letter, the revenue know about you. They've told you to make a disclosure before making an inquiry themselves, but that's still a prompted disclosure. So that does affect the penalty level and potentially the years involved as well. But generally, it's to do with the penalty scenario. So usually your penalties are going to be double because you've received one of these nudge letters. The ideal is you make a disclosure using the Let Property campaign, or if it's offshore property, the Worldwide Disclosure Facility, or if you're going to admit fraud, and we covered this in a previous webinar of ours, if you are going to admit fraud, you can make a voluntary Code of Practice 9 disclosure, contractual disclosure facility. You get an immunity from prosecution. It's a civil matter. Obviously, the penalties are high for admitting fraud. Equally, if the revenue open Code of Practice 9 investigation themselves, they consider that fraud has been suspected, deliberate behaviour has happened, and again, it's the more serious civil level of investigations that's just below criminal. If you fail to cooperate with the Code of Practice 9 inquiry, if you fail to make a full disclosure, the Code of Practice 9 inquiry, there is a risk HMRC will then turn to a criminal prosecution on that issue. So again, if you get a nudge letter, if you get an investigation, do not ignore it. Seek specialist help and take advice. If you've got income from property, if you've sold property and not returned the gain, then again, take professional advice before disclosing to HMRC, and the professional, which obviously includes ourselves, can help mitigate penalties, claim the best expenses you can within the law and rules, and minimise your tax exposure. So on that point, when we're talking about expenses, Dane now will cover those points.
Thanks, Dave. Yeah, I'm just going to talk through some typical items of expenditure that may be incurred in acquiring and running a property rental. Which of those might be allowable as deductions when you're kind of going to compute your taxable profits. When considering whether an expense is allowable in calculating the profits, we've got to consider a couple of things. Firstly, whether it was incurred wholly and exclusively for the purposes of the property rental business, and secondly, whether it was capital or revenue in nature. So the list I've got here is just to run through a few of those. So the acquisition of a property itself, that's going to be capital, and generally speaking, any costs associated with acquiring that property, could that be stamp duty, your legal fees, they would also be deemed to be capital. So you wouldn't get a reduction for them or a deduction in calculating your profits in a particular year, but when you come to sell the property, you'd get relief for that when calculating a capital gain on that disposal. Finance costs, that's probably the one that's the most interesting, the one that's had the most press over recent years. Most people may have heard of this as Section 24. Previously, you could get a deduction for your finance costs when calculating your profit, and HMRC have phased in now from 2017-18 a reduction to that. So instead of giving you a deduction when calculating your profits, you now essentially work out your taxable profit, work out the tax due, and then you get a tax credit for those finance costs of 20%. What that means for basic rate taxpayers is that there is no effect to the tax paid, but it's just kind of presentationally slightly different on a tax return. But those landlords in the higher rate tax bracket would be hit a bit harder. Their tax bill at the end of the year will certainly be higher. If one thing that's important to note on that, this restriction applies to kind of your traditional rentals or kind of buy-to-lets, HMOs. If you've got a furnished holiday let or a short-term rental, something that you let out for a weekend, a week at a time, if there's certain criteria for furnished holiday lets, if you fall within that category, that's deemed to be more akin to a normal business, not a property business. And so the rules are different there. That finance restriction doesn't apply to those furnished holiday lets. Repairs. So repairs are kind of a common revenue expense, generally allowable deductions when computing your tax liability. In deciding whether something's revenue or capital, you generally consider whether there's been an improvement to the property. Where there's been an improvement, it tends to be deemed as capital. There are certain things that kind of go slightly against that. Things like if you were to replace your single glazed windows with double glazed windows, there has been an improvement there, but HMRC would consider that kind of advancement in technology to be something that would be revenue in nature, so you could claim that as a repair. If you were to kind of cut a hole in a roof and put a new roof light in there, then that would be an improvement. That wouldn't fall within that kind of advancement. Professional fees, it depends on the nature of the expense that they relate to, essentially. So professional fees, your legal fees in acquiring a property would be capital in nature, but generally things like accountancy fees, management fees, they would be revenue in nature. So they would be allowable in calculating your profit each year. Travel. Travel is always an interesting one. So travel, yes, travel costs are allowable expenses, but you still have to go through the thought process when considering were they incurred wholly and exclusively for the purposes of the property rental business. So, for example, if you were to drive to visit a property that you owned in Cornwall to do an inspection, but you decided to tag on a 2-week holiday there, would that be wholly and exclusively for the purposes of the property business? No. So things like that wouldn't be allowable. However, if you just went down there for the day, did the inspection and came home, then yes, it would. With certain travel costs, certainly with having a car, there's inevitably going to be a split of use between kind of your private use and your property related use. So you can actually apportion it on a kind of a just and reasonable basis. HMRC would expect. So if you drove somewhere for a property visit, let's say it took 20% of your annual mileage, you could have 20% of the cost of the servicing, 20% of the cost of the insurance, but you could also have 100% of the cost of that journey. So if you had parking fees, toll roads, things like that, you could include all of that. Capital allowances or replacement of domestic items. So previously you could claim what they call wear and tear allowance. You didn't actually need to actually replace anything or incur any expenditure. It's a kind of a generous thing that HMRC used to have, and they kind of pulled it. That was calculated at 10% of your net rents. We'll now remove that, so you can have replacement of domestic items. So where you replace a bed for a new bed, you could have that as a deduction. But again, looking at whether it's capital or revenue in nature, or whether there's been an improvement, you couldn't replace a £200 mattress with a £1,000 mattress for a tenant. And I'm not sure many people would be putting a £1,000 mattress in there. But if you take that principle, you would only get the £200 as an allowable expense when computing your profits. Capital allowances. Capital allowances are allowable for UK property businesses, overseas property businesses. The main one that can take the best advantage of capital allowances would be the furnished holiday lets. Again, slightly different with the finance rules. Other property businesses wouldn't get the cost of putting furniture or furnishings into a property. You would get the replacement costs to an extent, but not all of the initial costs. Whereas for a furnished holiday let, you could claim capital allowances on a lot of those items. So there are certainly more benefits from a tax point of view to having a furnished holiday let over your traditional rentals. This is just a bit of a recap. So general principles, really looking at whether it's wholly and exclusively for the purposes, and whether it's capital or revenue in nature. Where there is a split, it's just looking at whether that's done on a just and reasonable basis. And the important, I've just put the types of property there really just to kind of, as I've kind of described on the previous page, there are differences in treatments depending on the type of property that it is. So it's just important to establish that at the outset. That with furnished holiday lets, it's a very specific set of criteria that needs to be met. If you meet that, then that's great. And I know in places like London, I believe there's a 90-day short-term rental limit that's been brought in. I'm not sure when that was brought in, but that would have an impact on whether you qualify as a furnished holiday let for the year, because you need to be available for rental for more days than that. So just important to establish that so you get the correct treatment and get the maximum reliefs available.
Thank you, Dane. Yeah, I mean, I think certainly some areas in the country where housing has been a shortage, it's been quite a contentious point that some landlords have been switching from long-term buy-to-let lettings to short-term holiday lettings to avoid maybe business rates and other things, and to obviously get a more advantageous tax position as well when with the financing and even selling the properties. So yes, we're probably seeing more and more claims for furnished holiday lettings, but it has to fit with the criteria as well. And obviously, you know, if you get more income, there's going to be more tax to pay. SDLT. So say the SDLT holidays have all finished now, which were used as a bit of promotion to get the property market moving again. Not sure if they really needed much of a promotion post lockdown. People seem to be wanting to move and get more space, or move into the country, or get bigger properties. So there's a room that can be used for work purposes. On that side, it's not part of this conversation really, although I suppose it comes in the principle of private residence. You do need to be mindful that if you have a room exclusively for work, that may result in a capital gain. You won't qualify for reliefs if it's exclusively for non-residential use. So you need to be careful and mindful about how you make claims on your property. But SDLT, we are seeing a number of issues here with revenue opening investigations. One is with properties owned by limited companies. The revenue are going through their records and information with Land Registry and other records they have, and opening inquiries into properties that are owned by companies who haven't paid the higher surcharge rates. So if a property is worth more than £500,000, there is potentially an extra 15% SDLT rate, not the standard 3, 5, 0, etc. Scale rates. There's 15% if it's owned by a company. So you have to be careful how that property is used, and there is quite complex rules around that. We are seeing HMRC look at these, ask for if they're qualifying, get evidence, and it potentially issue penalties as well for any errors with regard to the SDLT. So that is certainly a live topic which needs to be managed carefully if there's been errors or mistakes at the time of purchase with the SDLT. The other issue that is happening through the tribunals and in inquiries as well is to do with land and property where there's been mixed use. So with mixed use, what happens is if there's been an advantage in a reduced SDLT if you can distinguish, say, a residential property from commercial land. There will be a lower rate, there'll be separate rates of SDLT for each plot or each parcel that you've bought. So people may choose to do that. And in the Hyman and other cases, which is quoted there, that's actually the first tier reference. It's subsequently been appealed to the upper tribunal. The upper tribunal decided in the same way in HMRC's favour. There were actually 3 separate taxpayers making appeals on the grounds that when they bought the property and land, the land was not part of the property, on the grounds that it either wasn't a garden or it was used for grazing, or it was a commercial land. In all three cases, the tribunal decided that no, that's not the case. And again, this is an area that used to cross over with capital gains tax. The old guidance that the Revenue issued, which this upper tribunal specifically confirmed was wrong. The Revenue used to compare the SDLT rules to the capital gains rules around the fact that if the land was part of the enjoyment of the property, then it was garden. If it wasn't needed for the enjoyment of the property, then it maybe wasn't the garden. And the old Revenue guidance was that the SDLT rules followed that CGT rule. The tribunal has confirmed that was wrong. That guidance was replaced in 2019 anyway. Trying to rely on the old guidance for gardens, not an easy thing to say, is not going to get you anywhere. The upper tribunal sets a precedent, and guidance anyway is non-statutory. The tribunal do not consider guidance unless it assists with the construction of legislation or helps particularly with an understanding of the legislation. Otherwise, the tribunal has to consider the strict legislation, and strict legislation here for SDLT is there is nothing in the rules with regard to enjoyment of or part of the property. It's far wider than that for the SDLT. It's still relevant for capital gains tax. So if the land is too big for the enjoyment of the property, then potentially for capital gains you won't get the private residence relief because it won't be part of the garden. It'll actually be something else for which you don't get relief for. But for SDLT, it works the opposite way, and you would combine it and pay SDLT on the full combined value. So it's something to watch out for if you've got mixed use land and property, and certainly something to watch out for if you've got property that's owned within a limited company. And the other issue around limited company ownership is ATED.
Thanks, Dave. So ATED stands for another HMRC acronym, Annual Tax on Enveloped Dwellings, and it came in almost 10 years ago now. Essentially, ATED applies when a UK residential property worth more than 500,000. I think when it came in, it started at 2 million and it was reduced to 1 million. It's now at 500,000. So when a UK residential property worth more than 500,000 is owned by a non-natural person. A non-natural person could be a company, a partnership with a company member, a collective investment scheme. The clue is in the name, but it's an annual charge and it's payable in advance. So unlike a lot of the other taxes, you would file your ATED return in April each year for the upcoming financial year. You might not own the property for that full year, and you would have to kind of make an adjustment later on if it was disposed of. But essentially, it's a filing up front and a payment up front to cover the upcoming year. You don't always have to make a payment. In fact, I'll go back to that. The payments are based in bandings depending on the value of the property. So it's an annual charge. So there'll be bandings from 500,000 to 1 million, maybe 1 million to 2 million. There's quite a few of them. The most expensive one being for properties valued at 20 million plus, and the annual charge for that currently in this year is £237,400. That's an annual charge, like I say. So it's a hefty, it can be a hefty charge. So you need to kind of structure your affairs accordingly, knowing what those charges might be. There are reliefs available. There are a lot of reliefs available. This legislation wasn't introduced to kind of target those people or those companies that have bought properties to rent out on kind of commercial terms to unconnected parties. So if you carry on a business like that, then you will have a relief. Although you won't have to pay any ATED, you will still have to file a return each year. And we can kind of come on to the penalties that you might suffer. So if you are one of those businesses that you don't have any ATED to pay, you've got the qualifying relief, but you don't realise and you don't file your return, you will still be hit with late filing penalties. Late payment penalties, not so much, because they're kind of tax geared. They're a percentage. They tend to be 5% of whatever the tax outstanding is at various points. So you could have in total you might pay 15% if you filed it a year late. And then the final one is inaccuracy. So if you file a return and you either file it as a nil return because you've claimed a relief, or you file it in the incorrect banding, so you've paid an amount of ATED but you should have been in the higher banding, and we can come on to some of the pitfalls in a second as to why that might happen, then you would fall within the inaccuracy penalties. And the inaccuracy penalties kind of fall in line with those that we've talked about numerous times before for the other taxes as well. So it would depend on the behaviour. What led to that inaccuracy? Was it careless? Did you take reasonable care? Was it deliberate? And then following on from that, what the quality of your disclosure is when interacting with HMRC to see how far down the penalty banding you might be. So just a couple of points to take away really. Tips and pitfalls. File in advance. People might not be aware. You might have bought. People are moving towards buying properties in companies since the mortgage or the finance cost restriction was introduced a few years ago. It's not always the right thing to do, but people seem to be rushing to do it. So you've got to speak to an advisor, I think, to make sure that it is right for yourself. But when you're buying that property through a company, you will not often be told that you will need to file ATED return. So it can happen. It can pass you by without really knowing about it until you get that letter from HMRC. Valuation is a key one. HMRC have valuation dates. So the first one started on the 1st of April 2012, and then it's every 5 years. Obviously, property prices move, so you might not have been within the ATED realm because your property was valued under £500,000 when you bought it 10 years ago. But if it's gone up over from that, or if it's gone from one banding to the next, HMRC will be kind of keen. One of their key kind of metrics, I suppose, for picking up inquiries is how close to the next band are you. If your property was bought for £950,000 and the next band is £1 million, and 5 years has passed, could it have tipped into that next one? It's more likely to have done than one that was valued at £550,000. So they'll be the ones that they're targeting for inquiry. So it's important that you speak to an advisor, speak to a valuer, make sure you've got your kind of records in place to demonstrate why you might not have gone into that higher banding. The types of property, it applies to UK residential property. It doesn't apply to commercial property, and there are certain exclusions. So it's just about making sure that you know if what your property is and what the ATED implications are. For example, if you are letting it on commercial terms, you don't have any ATED to pay, but you have to file. So making sure that you're aware exactly how your kind of investment fits in with it. And then, sorry, Dave, go on.
No, sorry, I wasn't sure if you'd finished then.
And the final thing is, again, not many people will be aware of it until they've kind of experienced ATED with HMRC, is the pre-return banding check. Essentially, that's a facility that you can approach HMRC if you're unsure of a particular banding, and they can kind of give you their opinion. It's always helpful to kind of have your own advisors supporting you as well, but that's an avenue that you can get support from if you are struggling to understand something.
Thank you, Dan, and a very useful pointer there, especially with the fact that property has gone up in some areas 20% in the last 18 months since pre-COVID rates. So if you've had property that's more than 5 years old, become 5 years old, then that increase in value that's happened in the last 12 to 18 months is certainly something to watch out for. If you're on the cusp of those bands previously and moving to the new band, it's definitely worth taking advice if you're in that scenario. Thank you, Dane. That was very, very useful for everybody.
No worries, thanks.
Final point for me today is around private residence relief. This is to do with selling the property and reliefs with regard to capital gains tax. If you sell your main residence, you don't pay capital gains, providing it's been your main residence throughout. If you've let the property at any time during that period, then you will have to apportion that period for a capital gain. The big issue here is what qualifies as private residence. If you have more than one property, then you need to nominate and make an election of which one is your main residence, and you certainly need that in place before selling the property, because if you have two properties, you know what's going to happen. The revenue are going to say that one of those properties probably the one that you sold for the greater gain wasn't your main residence, and the revenue wants some capital gain on that. Thank you very much. If you have moved for various properties, or if you've refurbished a property and you've moved in and out of properties, then HMRC will be looking at that very, very closely to consider, was that at any point your main residence? This is an area we have been helping a number of clients for, and we do have experience in and successes with dealing with HMRC with regard to these claims, queries. Ideally, it's all to do with proof, evidence, document keeping. If you've bought a property, if you live in a property, keep those documents for at least 6 years and make sure you've got those as evidence that you were living there and that it was your main residence. Obviously, things like utility bills, your bank statements, post being sent to that address, any connections you've got of living in that property. And it's not just about the length of time. The tribunals have confirmed this in cases that it's not a question of you qualify if you've been there for 3 years. You qualify if you've been there for 3 months. Do you qualify if you've been there for 3 weeks? It depends on the quality of that residence, not the length of time. It's not been unknown, and we've certainly seen this where somebody buys a property, they move in, and then within a month they realise it's not for them. There's some issue, they hate the neighbours. They split up with their partner who didn't move in with them. There's a train that's just too noisy outside, and they move out again. Or the circumstances change to get a new job, and they move to another part of the country, and therefore let it out. It's still relevant that during that short period of residence, it was at that time their main residence. As I'm sure you can appreciate, HMRC may be sceptical if you've done that a number of times, or the length of time you were there calls into question whether it really was your main residence. But again, it's down to fact and evidence, intention of that property to be your main residence. So the fact you move out quickly shouldn't bar you from making the relief and the claim, but obviously you do need strong arguments, strong evidence as much as possible. If necessary, a case may have to proceed to mediation with HMRC. We've covered this in previous webinars, and we'll no doubt cover this again about the ADR, alternative dispute resolution. That can sometimes be the only way to resolve a case such as a contentious issue around capital gains tax and what reliefs. Unfortunately, 2020 made substantial changes to the rules as well. So letting relief has changed. The final period of letting changed. There used to be lots of further reliefs available, up to £40,000 maximum for letting relief if you'd let the property for any period of time, but also it was your main residence at various periods. And it used to be the last 3 years always qualified, up to the last 3 years always qualified for relief as well. So all these apportionment calculations would reduce the gain. That's all changed since 2020. So do take advice, do check on the rules and regulations when selling property, and ensure you make a timely declaration on your self-assessment of capital gains. What did happen in the November budget this year was that the October budget, what changed this year was that the 30-day rule to make returns for capital gains has been extended to 60 days. So it does give you a little bit more time to make those capital gains returns as well. To HMRC, you've got a 60-day window to make that return on a capital gain when you sell a residential property. So that's been us today. Thank you for joining us. Thank you for listening. Thank you for watching. We've covered quite a lot of areas today. You've probably gathered that there are a lot of risks involved with tax and property by way of either not disclosing the income, getting the expenses wrong, getting the SDLTs wrong. If it's owned by as Dane mentioned, non-natural person, company or partnership, then there are ATED to consider as well. There are obviously opportunities for tax planning, and our advisors here can assist with any planning before you make purchases or before you sell property. Do take advice. The Let Property campaign for UK property, the worldwide disclosure facility for offshore property are still available to make disclosures if you receive a nudge letter, and we can help with that. Or you can make voluntary disclosures with those scenarios. If, in the unfortunate circumstances, you are in a fraud, deliberate behaviour, tax evasion scenario, either prompted by the revenue or needing to make a voluntary disclosure to get the immunity from prosecution, again, Code of Practice 9, Contractual Disclosure Facility are available. You do need specialist advice to take that form. I don't think the IT is working today, so if you tried to put in a question to us, do apologise. If you've got any questions, please get in touch, give us a call at our office, drop us an email, d.jennings@churchill-tax-advisors.co.uk or d.skiba@churchill-tax-advisors.co.uk, and we will be happy to have a discussion with you on any issues you have, or refer you to one of our colleagues if necessary. Otherwise, thank you very much for joining us. We will be back next month, which will be the final webinar of the year. Can't believe we're nearly at the end of this calendar year. Doesn't time fly by so fast? Thank you for joining us today, and we will see you next month for a new tax investigation topic. Thank you. Goodbye.
Thanks.